Welcome to BizTech's Midday Market Watch. Our guest today is Stephen Innes, Chief Global Market Strategist at AxiCorp. Hi, Steve. Welcome to the show.
Thanks, Brian. Thanks for having me back on.
Let's take a quick look at markets before we get some insights from you, Steve. Now, markets very mixed. We've got the Nikkei, which is down 0.89% at 25,498.43. Shanghai Composite is 3,351.09. It's up slightly at 0.11%. The Hang Seng is down 0.57% and trading at 26,394.26. ASX is trading at 6,535.80. It's up marginally 0.007%. The Kospi is trading at 2,533.31. It's down 0.48. Bursa Malaysia closed midday at 1,590.99, down 13.76 points. And the SGX is down 0.17% at 2,783.9. Now, Steve, what is the reasons for that, given the fact that there is, after all, good news in the market over the last couple of years, yet markets are down?
Yeah, it's just a competing narrative. So we've got vaccine optimism that's playing favorably over the medium term. However, present day realities are that COVID continues to accelerate throughout the world. We're seeing it Tokyo, we're seeing it in Europe, and of course, the case counts in the U.S. are just quite shocking. And I think this is forcing a lot of political hands right now. We saw New York City School Board start to cancel in-class sessions. I think that's just the tip of the iceberg. We're heading into Thanksgiving. The thought here is that other institutions, including schools around the U.S., along with universities, are probably going to start game planning some more stringent measures post-Thanksgiving, where virtually everybody in the medical community is suggesting that COVID is going to rise. So I think we're still in for the short-term winter of gloom by the looks of things. It's going to weigh on economic sentiment. I mean, those green lights due to the vaccine are still shining brightly at the end of the tunnel. The only problem is the tunnel's gotten a lot more cavernous and lengthier over the past few days, and that's continued to weigh on short-term sentiment.
Then in that case, what's your view on the dollar, the yield curve, given this renewed optimism on one hand, but then the bad news now starting, as you said, filtering in and reality setting in?
You know, honestly, I think the only game in town is dollar Asia right now. That's because basically, for the most part, Asia has cleared the virus, although it's popping up in some hot spots. I think we're seeing that play out through the RMB complex, which seems to be, taking charge and really the center of attention when it comes to FX markets. Looking at G10, well, you're seeing some knock-on positive effects of countries and of currencies that are associated with the growth rebound in China, such as the Australian dollar, the New Zealand dollar, and other commodity currencies. The commodities are also looking quite good right now because of the vaccine impulse. However, we also have to remember that commodities are priced in spot markets. So if we're looking at oil, for instance, it fell simply because the anticipation of that near-term demand is going to continue to weigh on oil prices. So looking at the petro-linked currencies, it's not so great over the short term, but if we can look through the next few months, things brighten up quite considerably. Looking at the euro right now, well, that's a point of contention. Nobody knows where that's going right now. We're mired in a lockdown in Europe, and right now it seems to be in a holding pattern, not really in a rush to go anywhere.
Now, Steve, you touched on oil just now and oil demand itself. On one hand, and on spot prices, but then on one hand, you see inventories building up. So the EIA weekly stockpile data showed inventories rose by about 769,000 barrels. But at the same time, it was significantly less than the 1.24 million barrels that the market kind of estimated. What is your view on the oil market, given the fact that the optimism obviously stems from the fact that the air travel and travel as a whole, if we have an effective vaccine, is going to take off, and it has markets actually priced in that demand increase into oil prices?
You know, as far as the travel sector goes, I don't think we can even think about having an optimistic view until the end of 2021. I don't think planes, trains, or automobiles are going to be moving anywhere outside of their own little domain for the foreseeable future. Certainly, international travel is not going to be lifting off. Vaccines won't be readily available for at least 6 months. And that's even if people want to take it. There's this anti-vaxxer movement on right now that is, you know, a lot of people still don't trust vaccines, and why not? People don't.
Yeah.
People don't know enough about them. They don't know what the long-term effect is. So there's going to be reluctance there. Plus, I also think the fear here is with the COVID continuing to spread, people don't want to get trapped in another lockdown situation. I know I ran into several people up here in Thailand, had the misfortune of getting stuck in Thailand and not being able to get back to their home countries. Pretty expensive, really, when you think about it. So people are going to be a little bit cautious, you know, not traveling for the next little while. But getting back to the inventory data in the U.S., I think the data continues to run a little bit polluted simply because of the hurricane effect. So we're seeing some wild up and down swings on the inventory reports. I think the key metric here is gasoline demand. It's picking up here and there, but it's not a consistent draw on the gasoline side of the equation. And that's a little bit worrying because we should have expected a little bit more draw perhaps at this as we're moving into holiday season, at least some activity picking up, but it's not. Mobility continues to run cold. And the expectations here is that governments may even move to lock down Thanksgiving and even lock down Christmas. So, I mean, or the holiday season. So this is going to be quite negative in my view for oil prices. Look, we've got an OPEC backstop. You know, that's indisputable. Oil prices are not going to revisit the gloomy situations we had back in March and April. Just forget about that out of the equation. But the point is for investors, where are they going to go? Where are they going to go in the interim? Probably nowhere. That's my view. I think we're going to have to wait till we move into the 2021 scenario when the markets start to pick up in earnest again. And perhaps as we near that pricing in that vaccine impulse, markets tend to price in big risk-on events generally, you know, 3 months ahead of time. So perhaps we might start to see oil prices rise in the new year, but I don't think they're going anywhere anytime soon.
Now, Steve, something a little bit on a different tangent, Bitcoin. Now, it's rallied tremendously this year, and it's just about to test its historical highs of 19,783. I think it's just pulled back to about 18,000 right now. Now, what's fueling this surge?
You know, I think if you'll read a million explanations why it's going up, from anything from a technical blowout analysis to fear of missing out to whatever. But I think underlying Bitcoin right now is an asset that people are embracing. Well beyond just the currency debasement situation. I think because of the lockdown situation, people are now embracing online technologies more. And I think, you know, doing a lot of digital payments, moving into e-commerce quite greatly. And this is where blockchain really accelerates. And, you know, given the structural integration between Bitcoin and blockchain, I think this is a reason why people are starting to light up to Bitcoin. Look, we're going to move further into digitalized economy. Globalization through blockchain technologies is going to accelerate in the not too distant future. And given the fact that there's a finite number of Bitcoin in the market, I think large institutions are willing to take on that risk. Owning cryptocurrencies. Look at Fidelity, PayPal. Everybody's getting into the game. More hedge funds, more high frequency traders are getting into the game. This is also reassuring for retail investors, given that stronger hands are in the markets. It used to be a case where Bitcoin was viewed as a wild, wild west of assets and quite a risky assets. I think that name is sort of departing a little bit because these institutions that are entering the markets bring with them an element of risk management that'll keep the market a lot more stable, in my view. Look, we're always going to have volatility in any asset where you're making price discovery, or especially above recent highs. That's why we're seeing the volatility right now. But I think the volatility is going to even out as the year goes forward.
Hey, Steve, thanks for your insights. We've been speaking to Stephen Innes, Chief Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia